Hey everyone, hope you're all well. Given what's happened in the financial markets recently, understandably there's been a huge surge in retail investors, everyday people wanting to put money into stocks. And not surprisingly, on the app stores in Canada, Wealthsimple Trade has become the most popular download. With that in mind, in this video I want to talk about how Wealthsimple Trade works and some of the rules of the investor market, and in the process share some general legal and investing information and ideas that I think many people would find useful. As always, I'll put the links to the timestamps of these different topics down below. So the first thing is this feature of $0 commission on trades. The act of putting an order to buy or sell a stock on Wealthsimple Trade is free. This is a big reason why a lot of people have downloaded this app, and a big reason why its counterpart in the US, Robinhood, is so popular as well. But whenever you're getting a service out of a big tech company for free, you should start inquiring exactly what this transaction is. What is the true exchange between me and them that is going on? Remember, these big tech companies get massive investments and those investors expect a return, so nothing is really free. If you're familiar with billionaire investor Chamath Palihapitiya, who I'm sure many of you have been introduced to in the media in recent weeks, he stated many times that with a lot of these big tech companies, when you're not paying for their service with your dollars, you're paying with your data. That's oftentimes the real exchange that's going on, and he knows that quite well because he worked at Facebook for years, and Facebook uses that business model of providing a free service and taking your data for it. And for them, it's in order to help sell advertising. The Robinhood app in the US relies on payment for order flow, which is a similar business model of offering you a free service, but selling off your data. The data here is your buy and sell orders on stocks. They take the orders from users of the app, and instead of directly processing those trades on the stock exchange, they sell the right to execute these trades to market makers like Citadel. And why would Citadel pay for those orders? Citadel learns about the supply and demand for Gamestop and then uses that knowledge to inform its own automated high-speed trading. The same high-speed trading that you're competing against as a retail investor. As you can see, this method of monetization that Robinhood uses, though technically legal, presents a potential conflict of interest between the loyalty that Robinhood owes to the retail investor like you and me, and to the market maker like Citadel. The SEC in December even fined Robinhood $65 million for failing to disclose to its customers for over 3 years that it engaged in this practice. This is why just a couple of days ago, another investing app called Public announced that they would stop participating in this practice of payment for order flow, and I hope that many more companies will follow suit right now as the critical spotlight is on the capital markets. But now going back to Wealthsimple Trade, on Wealthsimple's website, they say directly that Wealthsimple does not participate in payment for order flow, meaning they are not taking your data and selling off your orders to market makers. They say that the way they are making money is from currency exchange fees for US trades, which means that they take a fee every time you buy and sell a US stock for converting your Canadian dollars to US dollars or the US dollars back to Canadian dollars. So they'll take a percentage of all your US trades, and based on their fee schedule here, the rate is 1.5%. So they're taking the currency conversion rate and charging you 1.5% on top of that rate. So if you're going to be trading US stocks on this platform, you want to keep this fee in mind. And in deciding which broker to use for your investing, like Wealthsimple, Questrade, one of the banks, whichever one, you want to look at their different fee structures and figure out exactly what you're paying on each trade in terms of commissions, exchange fees, and anything else. So Wealthsimple charges you a conversion fee on US trades, but it doesn't charge you anything for Canadian trades. No commissions and no conversion fees because it's all Canadian dollars. So if there's zero fees on buying and selling Canadian stocks, does that make Wealthsimple better for trading Canadian stocks than the other brokers who do charge fees? To help you decide that for yourself, there's one other factor to consider here, which is the best execution policy that the broker uses. But I'll get to that later in this video. Let's first talk about this situation where trades in GameStop were restricted. So the $0 commissions are what made Robinhood attractive in the US and by extension Wealthsimple Trade in Canada. Now recently what's gotten Robinhood the opposite type of attention was its decision to restrict trading in certain stocks, namely GameStop and AMC, and to only allow positions in these stocks to be closed, meaning you could only sell your shares of these restricted stocks, you couldn't buy any of them. The justification Robinhood gave investors for this decision was that it was necessary out of market volatility. Now in Canada, as far as I know, brokers were not fully restricting trade in these stocks. Wealthsimple provided a warning in regards to market volatility with these stocks. I think the TD platform had some restrictions on margin and options trading for these stocks. On the CIBC investing platform, it gave a similar warning regarding volatility and that additional processing time might be needed. But it also went a step further and said some limit orders that are far away from current levels could be rejected. But this potential for rejection could just be that CIBC is dealing with such a huge spike in volume at this time that they want to ease the load on them by rejecting very speculative orders that are not likely to ever materialize, so that they can focus on the limit orders that are realistic and likely to be executed. But in any event, this whole situation raises questions about what brokers like Wealthsimple Trade are permitted or legally required to do in market conditions like this. Are they allowed to restrict certain stocks? What can investors expect? Well, the first thing is that whenever you're using an execution-only service like this and not relying on any advisor with this sort of platform, you're generally agreeing to their terms of service by using it. And in those terms of service, the company will give themselves a whole bunch of rights to do things that can affect the service that they provide you. In Robinhood's user agreement, they explicitly give themselves the right to restrict trades in certain stocks. I haven't been able to find something similar in Wealthsimple Trade's terms of service, which seem kind of incomplete in comparison to the 33-page document that Robinhood has, but let's just assume hypothetically that Wealthsimple Trade and these other brokers in Canada all give themselves the right in this agreement. They have the freedom to set up their agreements as they want, and you have the freedom to use their service or not. However, what could limit the application of their rights in these agreements are the rules put in place by regulators of securities and the capital markets. In the US, you've probably heard of the SEC and maybe of FINRA, which is responsible for regulating brokers. In Canada, similarly, we have the CSA, the Canadian Securities Administrators, and IIROC, the Investment Industry Regulatory Organization of Canada. Now, the CSA and IIROC put out a joint statement just a few days ago. They said that they're monitoring this recent volatility in the market and will take appropriate regulatory action to protect investors if they identify that abusive or manipulative trading activity is taking place. So basically no explicit or formal rules or intervention from them just yet. They also say that they're in close contact with regulators domestically and abroad, meaning that they're also talking about this with both provincial security commissions and the SEC in the US. And they're also in close contact with the regulated entities, meaning they're also speaking about this to brokers like Wealthsimple. They also say that they're monitoring the issuer's compliance with disclosure of material information that might affect their stock prices, meaning that they're making sure that these companies whose stock is being traded are making public any major changes or statements or documents that the market needs to know about in order to make an investment decision about their stock. And then this last bit of their statement is a word of warning to investors that they should be careful where they are getting their information that they use to make investment decisions, because online chat rooms are unregulated and may contain inaccurate or inappropriate information for some investors. So this is clearly talking about Reddit and Discord and these sort of platforms that retail investors are communicating on. And they sign off by saying that the CSA and IIROC will continue to work to protect investors from improper and unfair practices in the capital markets. So as you can see, though they talk about this notion of protecting investors from unfair practices, there's no mention here of the issue of restrictions on trading stocks as part of that discussion. And this might be disappointing for some of you to hear, but this is very much in line, on brand with what they're really focused on, what securities and broker regulators in Canada and largely in the US really care about. After all, here's IIROC's mandate. IIROC sets high-quality regulatory and investment industry standards, protects investors, and strengthens market integrity while maintaining efficient and competitive capital markets. And obviously, very similarly, here are the three objectives of the Canadian Securities Administrators. 1, the protection of investors, 2, fair, efficient, and transparent markets, and 3, the reduction of systemic risk. Their goal is really about maintaining stability in the market. It's a very risk-averse approach. When they talk about the protection of investors, it's not about making sure investors have the freedom to trade in whatever they want, however they want, and making sure that they have a wide open opportunity to make a lot of money. Instead, it's really about protecting investors from getting caught in bad investments. The regulators want to make sure that you don't get bad financial advice, like advice that doesn't match your risk profile, or protecting investors from getting taken advantage of by brokers, or protecting investors from investing in companies that don't give them enough information or accurate information. If you want any further indication of how the regulators view what the market needs, you can look at enforcement reports of IIROC, remember this being the regulator for brokers in Canada. And in these reports, you'll see that IIROC characterizes brokers like Wealthsimple or Questrade as gatekeepers to the capital markets. The regulator says that brokers have an obligation to ensure that activities that may threaten market integrity are identified and dealt with in order to ensure that investor confidence in the markets is not undermined. When advisors fail to identify issues that threaten their clients or the markets generally, they have failed in their gatekeeper obligations. So the platforms that most retail investors are using to make their trades are literally by law supposed to act as gatekeepers to the capital markets. Being a gatekeeper is the exact opposite of what people might have expected about the role of brokers. For example, thinking that their responsibility is to facilitate investors to have the full freedom to trade in the capital markets. They are obligated to be the gatekeepers to protect market integrity, which again means stability and confidence in the market. Now, why stability and confidence in the capital market matter so much to the regulators is first, the fundamental purpose of the capital markets is to create a reliable marketplace that provides companies with financing to expand and grow in their business. And also why the stability matters so much in terms of the secondary market is because things like retirement funds, like pension funds, RRSPs, 401ks, are all relying on the capital markets. And so the regulators essentially have to babysit the market to make sure that these sort of investment vehicles are not put at risk because there's so much money on the line and the stakes are very high. Just to clarify, I'm not saying that this is the right approach or that I agree with it. I'm just telling you what ultimately motivates the decision-making of these securities regulators at the end of the day. Because you could very easily say what some of these hedge funds are doing doesn't seem to fit with this goal of fair and transparent markets or preventing unfair trading practices, or that brokers like Robinhood permitting only sell orders of Gamestop and not buy orders doesn't seem to line up with protecting investors from manipulative practices. And I think those are valid criticisms. So if we want to see that sort of change in the regulatory system, we have to make our voices heard. But again, for the purpose of this video, I just want to keep you all informed about what the status quo is. One last thing you should know about your rights as a client under the regulatory scheme is that under IIROC Rule 3700, you have the right to submit a complaint to your broker based on some form of misconduct that the broker has done to you. For example, it could be breach of confidentiality, unsuitable investments, misrepresentation, some form of inappropriate financial dealing with you as the client. And just to confirm, you have to make sure that the broker is regulated by IIROC, but generally all the big ones are. So under IIROC, the broker must have a procedure in place that sets out how to deal with your complaints. So for example, here's the complaint process that Wealthsimple has if you want to submit a complaint about something they did wrong to you. The brokers must acknowledge your complaint in writing within 5 business days, investigate it, and give you a substantive response within 90 days. If they don't give you a substantive response within 90 days or you're still unsatisfied with the response, you can file a complaint with the OBSI, the Ombudsman for Banking Services and Investments. And they are an independent body who will investigate your dispute with the broker. If you don't want to go through this route of dealing with the broker first itself over your dispute, you can also make a complaint directly to the regulator IIROC regarding the broker's alleged misconduct. This is just the complaint and dispute resolution process set in place by the regulators, but you always potentially have the option of lawsuits or arbitration to resolve your dispute with the broker, and you should speak to your lawyer to see whether that would be appropriate. Now, the final thing I want to touch on in this video in terms of investing in Wealthsimple is the act of trading itself, specifically putting in market orders and limit orders. And related to this is the obligation on brokers, again via IIROC's rules, this time 3119 to 3129, this is the obligation of best execution of client orders. Wealthsimple acknowledges this obligation itself on its website, saying that their executing brokers are obligated by law to get you the best available price in the market at that time. If you recall that $65 million fine levied on Robinhood by the SEC that I mentioned earlier, part of Robinhood's misconduct there was that Robinhood was claiming that it was executing customer orders at prices that matched or beat other brokers in the market. But the SEC found that this was false and that Robinhood was making customers lose money even more than what it was saving them by charging them $0 commission fees. So Robinhood was violating this obligation for best execution for its clients, the equivalent under US regulations of FINRA Rule 5310. Now, this obligation of best execution of client orders looks at not only the price of the security at execution, but also importantly, the speed of the transaction. In the capital markets, the opportunity cost of lost time can be huge. Investors need these trades to go through as fast as possible. The other factors of best execution also include the certainty of the execution and the overall cost of the transaction when costs are passed on to clients. The broker is also obligated to disclose to clients what the process is for best execution. So for example, on Wealthsimple's site, it tells you that market buy orders are actually submitted as limit orders with a 5% top limit added to your price, to protect you from paying more than 5% of the current market price if there's a sudden change. Meaning that if you put a market order to buy a share that's currently trading at $100 it will only get executed if the market price is $105 or less. But on the flip side, it says that for market seller orders, there is no such protection. They'll just get you the best available price they can. So if the price was $100 when you submitted the order to sell, and the best price that they can sell for now is $70, it'll still go through despite the substantial price shift. So as you can imagine, in the current state of high frequency trading in the markets, it's almost impossible to assess whether one broker got you the best price at the time of your market order or whether another broker would have been better. The generally prudent thing to do as an investor is to use limit orders instead of market orders, especially in times of volatile price changes like recently. As the Wealthsimple site further down explains, limit orders will only execute based on the specific share price threshold that you provide. So you either provide the lowest you're willing to sell for and the trade will execute only equal to or above that price, or the highest that you're willing to buy for and the trade will only execute below or equal to that price. So with limit orders, you protect yourself from volatile prices because you set the prices yourself. The downside to limit orders is that since you set the price, the stock may never actually reach those prices and your trade might not go through, depending on, of course, what time frame you assign to the trade. On the other hand, with market orders, and putting aside that the Wealthsimple market buy is actually a limit order, generally with market orders, the advantage is that they'll execute immediately as long as there's some volume in that stock, but you don't get the certainty over the price that it'll execute at. So based on these characteristics, when it comes to this best execution obligation on the broker, for market orders, we're heavily concerned with what's the broker's ability to get us the best price, and with limit orders, we're more interested in how long they take to execute when it reaches the price, and the reliability or certainty that they execute when it reaches that price. And so remember earlier in the video I said that for Canadian stocks, Wealthsimple doesn't charge you commissions on trade, but to decide if they're the best for you, you need to take another factor into account. And this other factor that I was talking about is how they conduct their best execution obligation. Because the actual cost of a transaction, the actual cost of a trade is not just the commission or exchange rate fees, but also how reliably is the broker executing for you, how long are they taking to do it, and what price are they getting for you if it's a market order. Remember, Robinhood was fined by the SEC because even though it was charging $0 commissions, it was hiding the fact that the actual cost of its transactions for its customers was more than the other brokers. And the reason the cost was more was because it was getting customers worse prices through its execution policy of payment for order flow. As I mentioned earlier, Wealthsimple has stated that they don't get paid for order flow, which is good, but that's not conclusive in terms of the quality of their best execution policy. That's something that you need to research and investigate for every broker. So the takeaway here is that just because a broker charges $0 commissions doesn't necessarily mean that they're the best broker for you. You have to consider these other factors, and admittedly these factors like speed and price aren't straightforward to track and compare for an individual investor, but you should still consider them. And of course the opposite could apply as well, meaning just because a broker is charging you commissions, don't take that as clear evidence that they must have a high quality best execution policy and get you the best prices and the fastest and most reliable limit order executions. It all depends. I just want you to be aware of these different factors so that you can make a determination of what the actual complete costs of a transaction are as an investor, and to keep these in mind. So I hope this video was useful. I acknowledge that this GameStop and stock market topic has thoroughly been examined on YouTube, but I figured that a more specific discussion of Wealthsimple Trade as Canada's popular Robinhood style app and the Canadian capital market regulations would be a more nuanced and useful look for the many new retail investors in the market. So let me know what you think in the comments. And please make sure to hit the thumbs up and subscribe to the channel for more. Until next time.